Hi, this is Brandon Bischoff. I'm Vice President of Portfolio Strategy at Canterbury Investment Management. Today is June the 29th, 2020.
And I'm Tom Harden, Chief Investment Officer at Canterbury Investment Management. And we have the millennial in a suit today. That's particularly impressive since it's about 100 degrees with 90% humidity out there. But today we're going to talk about three separate subjects. The first one is going to be about the three different styles of managing a portfolio. So we're going to talk about strategic asset allocation, and then we're going to talk about tactical asset allocation, and then the third type, which is where we're going to focus, which is adaptive portfolio management.
The second subject we're going to go over is the three different types of market environments, which are bullish, bearish, and a trading anomaly. And then lastly, and most important, Tom and I are going to go through our adaptive portfolio strategy and how it's navigating the current market environment, as well as the 4 steps we need to put in a new portfolio high.
So we'll start with strategic asset allocation. Now, with strategic asset allocation, each investor is assigned a fixed percentage asset allocation divided among cash, stocks, bonds, and sometimes alternatives. The allocations are based on the investor's individual risk tolerance and their personal investment objectives. For example, a high percentage of bonds versus stocks would be assigned to a conservative investor. On the other hand, a more aggressive investor would be assigned a higher percentage in stocks and would have a small, if any, percentage allocated to cash and bonds. The portfolio would be periodically rebalanced back to the original allocations following a big move in the market, whether it's up or down.
Yeah, and we also have tactical allocation, which is a form of active portfolio strategy. And in tactical allocation, a portfolio manager will make substantial changes to the percentage in asset classes held. They'll use market timing. The allocations are going to shift between, maybe 2 asset classes, like either stocks or cash, or maybe they use 3 by using cash, stocks, and bonds. But the point here is that tactical allocation is going to use some fundamental or even some technical indicators to try to time the market. The objective is to produce a high risk adjusted return by just owning the best asset class as each one goes in and out of favor.
Well, then the last is adaptive portfolio management. And that was developed to deal with the fact that all traded financial securities will experience both bull and bear market environments. The most efficient portfolio is made up of the combination of securities that can produce the highest risk versus return portfolio, the one with the highest return and the least risk. The efficient portfolio is a moving target because markets are dynamic. They're always changing. In other words, the allocation in securities will perform best in a low-risk bullish environment, will look very different from the allocation that performs best in a bearish or volatile environment.
Yeah, and the adaptive portfolio is based on the same principles that you use in your home thermostat. A thermostat makes adjustments to maintain a consistent indoor temperature through variable weather environments. If it's snowing outside, it's warm on the inside of your home. And in adaptive portfolio management, it utilizes software applications to monitor changes in the portfolio's volatility, the portfolio's benefit of diversification, and its overall efficiency. And the objective is to maintain a low-risk, stable portfolio that can adapt and move in concert with these ever-changing market environments, which come in forms of both bull and bear. So we have 3 different types of market environments, and the first of those is a bull market environment.
And a bull market is what we all know and love. Bull markets are where most of the money is made. Characteristics of a bull market is low volatility. There's not a lot of outlier days. Most days are probably under 1.25%. They tend to put in a high, then they get a pullback, higher high, higher low, higher high as they trend up. There's an old saying about bull markets is that they crawl a wall of worry. In other words, markets are counterintuitive, and it seems like they go up, and as soon as you get that 5 to 10% correction, people begin to get really scared, and they think, was this the end of it? And then the next thing you know, they come back and put in a higher high.
And that's really the opposite of our next market environment, which is a bear market environment. So like bull markets crawl the wall of worry, bear markets actually slide a slippery slope of hope.
Yeah. So again, being counterintuitive, you see a sharp, with a lot of outliers, sharp decline in the bear market, and then you get an equally sharp advance, maybe 10, 12%. And people are like, oh, it's over. The market's going to go up, and the next thing you know, it goes right back and puts in a lower low.
Yeah, so in other words, bear markets, unlike bull markets, have high volatility and high risk. And there's really two main components. Bear markets have a lot of drawdown or high drawdown, sometimes exceeding 20, 30, 50%. And time. Bear markets take a lot of time to occur. So from peak to trough, it might be 1.5, 2, 3 years to get there. And then another 3 to 5 years just to get back to a point of break even.
Right, sometimes longer.
Yeah.
And you do see a very clear pattern of a low, lower high, lower low, a lot of volatility, a lot of outliers.
Yeah, so whereas a bull market is generally contained to about 1.5, 1.25% or in between it. Bear markets can see 5% up days, 10% down days, just very wide ranging days.
And you've heard the saying too that, hey, if I miss the 10 biggest up days, my returns are really low. What they don't say is the big up days and the big down days occur during bear markets.
And that kind of brings us to our third different type of market environment, which is a trading anomaly. And trading anomalies are typically going to occur out of a low-risk bullish environment. So we've said in the past, volatility can get squeezed down like a spring. Well, a trading anomaly is going to come out of that. The market's going to get hit in the face, the cold splash of water. It's going to go down out of nowhere and then kick back just as quickly.
Yeah, a day that's maybe down 2 to 3%. You get a couple of those, it scares everyone. The next thing you know, it goes back to acting just like normal. It's just part of a normal bull market. And then
we have the extreme trading anomaly, which is kind of like what we've seen. Basically on I think it was March the 9th, the market's sitting about 12% off of its high, which is within a normal correction.
Range.
And then you see a 7.5% down day, and all of a sudden you're down 20% off the peak. A couple of days later, you're down 34% off the peak.
So the question then is, are we in a bear market? Is this a bear market, down 34%? And also, the definition of a bear market is a decline of 20%, kind of an arbitrary number.
Yeah, so is this a bear market, or is this something else?
And then what do you do about it?
So before we discuss the current market environment, whether it's a trading anomaly or a bear market or something else, we want to talk about our objective for investment management.
Right, and really all investors have the same objective, and that is we want compounded returns. And when we used to talk about compounding, it had something to do with the savings account back when rates used to be higher. And your savings account would go up and it would double and double again, and you would get what they call compounded interest. Well, the same thing is true with financial markets. And the challenge is that we have these drawdowns from time to time, and every decline, every substantial decline takes a much higher percentage to get back to break even. So first of all, we want to use a process that can really limit those. And then sometimes we have like a trading anomaly like we had this year where the drawdown was there, would exceed a normal correction. But what's even more important than the drawdown is the amount of time that it takes to get to a new high. So in other words, we only make money in the markets, or we only make money in our portfolio when the portfolio puts in a new peak in value.
Yeah, and in addition to that, once we put in a new high in the portfolio, what's the probability of being able to hold that? And that kind of brings us to this chart that we're going to pull up here. And this is a chart of the S&P 500, so it'd basically be just an all-equity portfolio. And you can see that it goes back to about, the start of 1996 all the way through 2015.
Yeah, and we went through the 1990s. Some of you remember that, some of you don't. But I think if you started in '92, your average return would have been like 21 or 22%. And I remember back then, it was at the point where people thought, well, we'll never have another bear market, with baby boomers going to be retiring, et cetera. And then when you think that the market's going to continue to go up, we had Y2K, no big deal, then what happens? The opposite.
The opposite occurs. So you see a 40% drawdown in 2000, followed by, you get 100% retracement, and you're back at the same spot you were back at in 2000. So it took you years to put in a new high, but you weren't able to hold that high, because as soon as you hit, 2007, 2008, you saw the financial crisis and another large drawdown. So kind of in summary here, here's 13 years that this, kind of equity portfolio went without actually making any money.
Right. And another thing to keep in mind is, people between 2009 and 2013, you'd have a big run up and people thought they were making money, but they weren't. They were underwater. And this, as you said, is a 13-year period to get nowhere. So what does that do to your compounding? Let's say maybe if you could have had one double during that period and $100 would be worth $200. Well, the next double would be to $400. Or if you could add two doubles and 100 would be to $400. What if I start from a $400 base for the next double instead of starting back where I started at $100? So the two things that we don't want are, number one, drawdowns, but even more important than that is we need a short period of time, as short as we can keep it, between one high, one peak in our portfolio and the next following high. And then as Brandon says, even if the market comes back and puts in a new high, in this kind of volatility, what are the probabilities of holding that? You're within 30 to 40% even. So again, that's where adaptive portfolio management comes in, to be able to limit the downside, and if we have a trading anomaly, to be able to get back relatively quickly to where we can get a new high in the portfolio and then have hope of being able to hold that high within a reasonable level before we put in the next new high.
Yeah. So I think it's safe to say that the type of market environment that we're in today is much different than the market environment we've been in for the last 10 years. And so we want to talk about, where that changed and how do we navigate and adapt to this new market environment that we're in today. So here is a chart of the S&P 500, and you can see at point number 1, which is on February the 19th, the market is at a new all-time high. Volatility is low. It's about a Canterbury Volatility Index of 52. And it's generally low risk, but it's kind of squeezed down like a spring. You know that there's a probability that an outlier day can occur.
Right.
So a couple days later, after that all-time high, you see that. You get about a 4% down day. And within, 2.5, 3 weeks, you're now 12% off of the peak, or within a normal bull market.
Normal correction.
Yeah.
Volatile, but a normal correction.
Yeah.
And then on March the 9th, everything changed. This has now thrown us into an entirely different market environment than what we've seen since 2008. On that day, the S&P 500 dropped 7.6%. That is substantial. So you went from about a 12% drawdown to a 20%. And again, technically, that's the definition of a bear market, 20% in about 20 some odd days.
Yeah, and so the question on, March the 9th or following that day is, what do you do about that from a portfolio management perspective?
So we really have two choices. You can sell everything or sell most of it. The problem is that the market is highly irrational at that point. The probabilities are just as high that it would kick back and potentially even put in a new high, leaving you back in the dust, and you'd never be able to make that up. Or the other option could be
to hold your current positions, because with the market's volatility and the type of volatility it was experiencing back then with these, 7% down, 7% type up days, it's all sort of fake pricing. So the market was sitting 20% off the high. Whether it goes down to 34% like it did before it kicks back, it doesn't really matter. The further that thing drops and the faster it drops, the more likely you are to get that snapback rally to be just as powerful.
Right, and an important point is a 35% drop most of the time would take about a year and a half for that to happen in a typical bear market, and a long time for you to be able to adjust. Well, here we have about 20 days. This is a true trading anomaly, and as Brandon says, the percent and the numbers really don't matter, because you're going to get a sharp kickback rally when you least expect it, and it's going to be fast. And I think retrace 40 to 50% of that within a few days.
And that's exactly what happened. So if we look at this chart comparing the portfolio thermostat to the S&P 500 and to the Russell 2000, you can see the sharp drop was followed by a sharp rally.
Right.
And so from a portfolio management perspective, we held our positions to participate in the first 40 to 50% retracement for that rally. And then we stabilized, because you're now in a new type of environment, one that is more volatile.
So had we not held our positions, we wouldn't have gotten that 15% kickback rally over just a few days to get back 40 to 50% of where we were before. So the idea is that the portfolio was inefficient through that period, and we wanted it to be inefficient. If we would have put the inverse funds on earlier, we wouldn't have gotten the kickback rally. After we got the kickback rally, then we stabilized it. And I think now, Brandon, we'll get into an explanation of what happened from the time we went through the stabilization process up through today.
Yeah, so if we're looking at this chart, going back again to the Canterbury Portfolio Thermostat, the S&P 500, and the Russell 2000, we can see that the black line, which is the one in the middle there, is really, really stable. It's flat. It's basically a flat line.
Yeah.
Whereas the Russell 2000 and the S&P 500 are, have much more volatility, both up and down. And we can see basically since we stabilized, we experienced what we call a dash for trash. The Russell 2000 or small cap stocks had significantly underperformed through this period. And you can see over the span of, I believe it was about 3 weeks, they actually go up about 25%. And the S&P 500 goes up about 11%. This is led by
flat.
Yeah, and we were flat. This was led by airlines, it was led by casinos. Anything that had gotten slammed, like cruise liners, was going to go up during that period.
Right, and they were still down about 50% from where they were.
Yeah.
Now, this is something that's important to understand in this kind of an environment, in that we don't know which way it's going to go from here. I think the probabilities are much higher that you'd go back and maybe retest the low or have some down period. This advance occurred in the absolute worst stocks, which are the ones that we actually had inverse. But as you look at our line there, we weren't fluctuating more than about 2% or so from the peak to the trough. If you could see nothing in the world except for our portfolio, you would think that absolutely nothing was going on. And we have inverses and long positions. To be able to stabilize the portfolio in that way is something that I don't think anyone else has been able to do.
Yeah, so regardless of what the markets do from here, whether they have another 6% down day like we saw 2 weeks ago, or a series of 2.5% down days, the portfolio thermostat should stay relatively flat.
Right. So Brandon, that leads us to the 4-stage process of how we manage a difficult, volatile environment like this. We did this, did a video on this a couple weeks ago to kind of give you an update. The first stage is the sharp decline, as we discussed before. Not a lot you can do about that. You just have to ride it until you get your 40 to 50% rebound, which is what we did. And then from that point on, the portfolio thermostat has been dead stable. Now, we also had that one sharp advance, which again was kind of fake pricing that came in the absolute worst stocks, and then they've retraced back about half of that. But from here, we should be able to keep the portfolio stabilized. Volatility, which has been the killer, will actually help us as the market fluctuates up and down.
Volatility is going to work both ways, and as the market pulls back, say 10 to 15%, we're going to be able to add exposure, and then when it gets that kickback rally, we can reduce exposure and sort of ratchet our way to a new portfolio high.
One of the big traps I see that individuals fall in is to say, what's my return over a specific period of time? Like, how am I doing year to date? How's the market doing for the last 3 years or 1 year or whatever? Markets, most of the money that's made in markets happens over relatively short periods of time. And markets don't understand the calendar. It would be nice if they go up 10 or 12% every year and went up consistently, kind of like a savings account used to. But they don't do that. And I think that particularly a good example would be if we go back to the peak in February and then look at where it is today. So what you saw was the market declined about 35% and then rebounded back maybe 45 or so to get somewhere near its old high, but it didn't actually get to a new high. And so someone say, well, then how's the market doing, or how are we doing up to a specific date? Well, which price was the real price? In other words, we started at a peak in February, it dropped 35% and went back. Well, whichever day you chose, you're going to get an entirely different number. When the markets are volatile like this, the pricing really doesn't matter. It's fake pricing, because we also know that given a short period of time, sometimes weeks or days or a few months, you're going to see an entirely different picture. And the real time frame for our portfolio is the rest of your life. I mean, you can be successful for years and years like they were in the 90s, and then next thing you know, give it up. In 2 or 3 years, the first part of the 2000s, or even if you stuck with it for a longer period, give it up over the next 9 or 10 years when you have 250% declines. So the real objective here is to be able to stabilize the portfolio when the markets get difficult, and then we benefit from the fact that the market fluctuates. The market has wide fluctuations, and if we can stabilize the portfolio, then we get what we call the ratchet effect. Market declines, you're stable. Market goes back if you come off a bigger base. Market begins to get way oversold, take an inverse fund off. As it gets overbought, put a couple back on. And it takes time as we go through that kind of an environment, but that is the new environment we're in now. We're no longer in this low volatile, steady, crawling a wall of worry kind of market. We are now in a volatile environment, which is virtually opposite of what we had over the last 9 years, which was opposite of what we had in the 9 or 10 years before that, and was opposite of what we had in the 1990s. You have to adapt to what type of market that we're in, and that's what we're in today, and it's going to require an adaptive process to be able to deal with the kind of volatility in market we have today.
Yeah, and that kind of brings us to the end of this week's Canterbury Update. Thank you, and we hope you have a great week.